So after that riveting conversation about law, now we're going to talk about accounting. All right, so I really want to focus on two pronouncements that are out there. We've talked about them for the last couple of years as pronouncements that are coming down the road, but they're now here. Down the road is no longer there anymore. We're now here. So the first one has to do with the new financial statement standards. So there are new standards out there regarding financial statement presentation. They're effective for years starting after December 15th of 2017. So for anybody who's a calendar year filer, you're in the year now. Your calendar year 2018, these rules are in effect. For anybody who's a fiscal year filer, so if you're at, let's say, a March 31st or a June 30th year end, April 1st or July 1st, these rules are going into effect. Okay, so just keep in mind that we're in a situation where this stuff is now relevant. It's no longer kicking the can down the road. It's here and now. The rules for the financial accounting standards are applied on a retrospective basis. The thing, though, is if in the prior year you didn't provide or you're presenting comparative financials and you didn't do a statement of functional expenses in the past, you don't have to go and do a statement of functional expenses for the prior year. You do have to do one for the current year, but you don't have to go back and create one for last year. And certain disclosures regarding liquidity that are required under the new standards. Again, you don't have to go back if you're presenting comparative financial statements and deal with those liquidity disclosures for prior years. So even though it is retrospective, there are some parts of it that are not retrospective, and you only have to worry about moving forward. So what are some of the key changes? The first one is net assets. I mean, everybody knows right now we have certain net asset categories. We have our unrestricted net assets, we have our temporarily restricted net assets, and we have our permanently restricted net assets. Under the new standards, it's either going to be with or without restriction. So you're going from 3 classes of net assets down to 2 classes of net assets. So obviously your with restriction will be your temporary and permanently restricted net assets, and your without restriction will be your unrestricted or board designated net assets. Some of the other changes that you have is in the past, if you had a long-lived asset such as a fixed asset, and let's say you acquired a fixed asset through a grant, all right, and that, or through a restricted contribution, I'm sorry. So you acquired a fixed asset through a restricted contribution, a building, and you were depreciating that building over 30 years. Under the old rules, as you depreciated that, you could release the restriction in accordance with the depreciation. So you could keep the net assets associated with the building as restricted, and as you depreciated the building, a piece of it would become unrestricted each year to match the expense that you recorded. Not under the new rules. Under the new rules, once you put the asset in place, the asset is unrestricted. So there's no longer the ability to depreciate the asset and record the release of restriction on depreciation. So if you have any long-lived assets that you were doing that with, you now have to change your accounting method for doing that. Another change is underwater endowments. Okay, everybody know what an underwater endowment is? So an underwater endowment is an endowment. So endowments are either quasi-endowments or real endowments. A quasi-endowment would be a board-designated fund where the board has put aside certain funds for long-term use of the organization. A permanent endowment is really the permanent restricted funds. So if someone gives you permanently restricted funds, have a nice trip, David. If someone gives you permanently restricted funds, in the past, if those permanently restricted funds were invested and they went down in value, that decrease in value would be borne by the unrestricted funds. So you'd basically be paying for that decrease in value in the unrestricted funds. Now the new rules say, nope, the decrease in value has to follow the original corpus of the asset. So if the asset is a permanently restricted net asset, the decrease in funds, or that underwater, stays in the permanently restricted category. So if you've had a permanently restricted endowment that was 20 years ago, and that endowment has gone up and it's gone down and sideways and whatever, you now have to go back and figure out what the historical value of that endowment is, so that you can record it, because there's certain disclosures that you're going to have to put in your financial statements. And remember that decrease in value no longer resides in your unrestricted, it now resides in your permanently restricted. So you're going to have to move that decrease in value back over to permanently restricted, and you're going to have to disclose in your financial statements what the historical value of the investment was, as well as what the current fair market value of the investment is. Everybody got that? Everybody understand that? Kind of want to make sure. Again, if you have board designated funds, you have to disclose the purpose of those board designated funds. It's something, amounts and purpose, something we've always done, but it was never really a requirement before, but now it's required. So just make sure that when you're doing that, you're disclosing both the amount and the purpose of board designated funds. Also, please make sure that if the board is designating funds and the board is undesignating funds, whatever the board is doing, make sure it's in the minutes of the board of directors meetings. We see a lot of times that, our clients will say, oh yeah, that's board designated. Oh, the board undesignated that. Well, where's it written? So just make sure if the board is doing something that it's kind of outlined clearly in their minutes. Can everybody read that clearly? It's a lot smaller. Use the version in your slides because that's kind of small. So again, in the past, I mentioned this, underwater endowments were included in unrestricted net assets, and you would just have to disclose the amount of which the endowments are underwater. So that was the only requirement. You'd have to disclose the underwater amount, and you'd have to put it in unrestricted. Now it goes into wherever that net asset is. So again, it would go into temporarily or permanently restricted net assets. You have to disclose the amount like you always did. But again, you have to disclose cost basis and fair value. And then you also have to disclose your interpretation of the ability to spend. So you have to kind of lay out what the spending policy is, or your interpretation of what the spending policy for that net asset is. So are you allowed to spend it? Are you not allowed to spend it? Must you hold it? And remember, that comes from donor intent. So that'll go back to the donor document. So you'd have to go back to the donor document and look. If the donor is silent, then remember, MIFA comes into place, the Uniform Prudent Management of Investors Fund Act. So you'd have to look in terms of that, and the board would then have to determine what its interpretation of the endowment is based on MIFA, MIFA, I'm sorry. So again, when we talked about net assets, you look at the old guidance had your unrestricted, had your board designated, had your temporarily restricted, had your permanently restricted net assets. Now you just have your net assets with donor restriction and without donor restriction. So two categories. If you want, you can still include under without donor restriction, you can put your unrestricted and board designated underneath as a subcategory of it. And under with donor restrictions, you can put your temp and perm as subcategories. But again, the requirement is to call them, the nomenclature changes in essence to with and without. Also, you have to disclose the donor restrictions within the footnotes to your financial statements. So make sure all donor restrictions are disclosed in the footnotes to the financials. Some other things that they've changed. You now have to have a classified balance sheet. So a lot of nonprofit organizations never really classified their balance sheets. So what they had is they had their assets and they had their liabilities, but they didn't break their assets up between short-term or current assets and long-term assets and break their liabilities up in terms of current liabilities and long-term liabilities. That was never a requirement before. It is now a requirement. So under the new accounting pronouncement, you actually have to break up your statement of financial position between current assets and long-term assets and current liabilities and long-term liabilities. You need to show those assets and liabilities in the order of liquidity. Okay, so when you think about liquidity and you think about assets look at liquidity in terms of how quickly are those assets going to be converted to cash. So, excuse me. So obviously cash is your most liquid asset because cash is already cash. So you'd have your cash, you'd have your investments, but then you would look at the rest of your assets and look at how quickly they would turn to cash, and whichever one's going to be liquidated to cash the fastest would get listed next in the order of how they convert to cash. And on the liability side, it looks at liquidity also, and it looks at if you were to close in essence, who would get paid first. So if I've got secured debt would get listed first, because on a close, the secured debt has a secured position, so they would get their money first. And then the people who get paid last are your normal creditors who are in an unsecured position. So it's really just changing in some respects the order of how the assets and liabilities may be reflected on your statement of financial position. You also are required to disclose how funds will be used and the liquidation of assets. So you have to actually think about it. I mean, I have certain net assets right? So somebody gave me temporarily restricted net assets, or I might have board designated net assets. So I have different net assets that have either been set aside by the organization or set aside by or restricted by a donor. So I've got these net assets. I have to now look at those net assets and determine, are there any liquidity issues with respect to those net assets? I could have a board designated fund where the board said this is going to be designated for capital expansion. And if the board plans on doing that capital expansion within the next 12 months, that could be short term. If the board doesn't plan on doing that capital expansion for 2 or 3 years, and if I've got that money set aside in a bank account, is it really current? Maybe not. Maybe it should be long term. What's the liquidity of that money? I can't really use it for anything other than what the board has designated it for. So there's going to be some additional disclosure requirements when you deal with the liquidity of assets based upon really the intent of a donor or intent of the board. And then, as I mentioned, the board needs to evaluate. So if you look at example on the bottom is a board of directors designates $3 million to be used for future expansion. This $3 million resource is not necessarily available to handle short-term obligations. So you'd be kind of looking at that as a long-term investment. So you need to focus on how and when the resources are going to be used. That's really kind of the thought process you go through. How am I going to use this money and when is it going to be used? And that's kind of what you have to think about when you're doing all the disclosures. I know most of our clients are just going to say, handle it, guys. This one's really small. So this gives you an example of what a classified balance sheet looks like for any of you who aren't already doing classified balance sheets. So you can see you have your current assets with the total current assets, then you have your total assets, you have your current liabilities with your long-term liabilities separate, and then you have your net assets with and without restriction. So what other things are changing due to this new financial standard? Does everybody love this new financial standard? We need to show on the statement of activities, so that's kind of your P&L. We need to show operating and non-operating activities. So if you have certain activities that are deemed to be non-operating, so in a lot of organizations, your investment income. You know, a lot of organizations, their business is not to invest funds. So the investment income that's coming into the organization could be non-operating. You have some organizations that rely heavily upon government funding, and contributions is really not a significant part of their operations. So that might go under non-operating for certain nonprofit organizations. So you do have to segregate your statement of activities between operations and show your operating results. And then you have to show your non-operating to show then the total results of the organization. So you're splitting it between operating and non-operating. Investment expenses. In the past, investment expenses were treated as expenses. Now those investment expenses are being offset directly against the investment income. So you're going to take those investment expenses, and those investment expenses consist of both if you're paying a fund manager to manage the funds, or if you have internal staff that are directly involved in investing those funds, the time associated with those internal staff. And those expenses, like I said, get directly charged against the expense. So when we look at the statement of functional expenses a little bit later, all of the expenses of your organization go into the statement of functional expenses except for investment expenses, because they're not really considered an expense of the organization. They're considered an offset to the income. In the past, only health and welfare organizations were required to have a statement of functional expenses. And now all of you guys get to join the party. Everybody gets to have a statement of functional expenses. Also in the past, your statement of functional expenses could be in your financial statement as supplemental information. So if you looked at your financial statement, you'd have all of your regular statements. You'd have your statement of financial position, your statement of activities, statement of cash flows. You'd have all your notes, and then you'd have your supplemental information in the back with your statement of functional expenses. The new accounting pronouncement says, nope, you can't have it in the back anymore. And the reason is when it was in the back, the auditor who was auditing it was is giving you less reliance on that statement than if it was a core statement of the financial statements. So the new pronouncement says, no, this really is a core statement. That's a required statement. So they want that now to be upfront. So that will no longer be, once you adopt this, a supplemental schedule. It'll now be part of your core schedules within your financial statements. And it's required for all nonprofit organizations, not just health and welfare organizations. On your statement of cash flows, everybody loves the statement of cash flows. It's probably the least looked at and least understood statement of all. It's kind of like me. But anyway, when we look at the statement of cash flows, you could either have a direct method or a non-direct method in terms of how you lay out the statement of cash flows. Under the new pronouncement, you're still allowed to use either one. They were talking about eliminating the direct method and just eliminating the non-direct method and just allowing the direct method. And they said, nope, too many organizations would not like that. So they said you can use either method you want. But they also removed the requirement to prepare the reconciliation in the direct method. So there's a little reconciliation between operating and on the bottom of the direct method, there was a little reconciliation of where the operating funds were used or how the operating funds were used. That little reconciliation on the bottom is no longer needed for nonprofits if you use the direct method. I don't know why anybody would want to use the direct method, but I like non-direct. The new standards also require you to outline within your notes to the financial statements your expense allocations. So you have different expense allocation methodologies. So everybody needs to put together, if they don't already have it in place, they need to put together what their expense methodologies are. So you need to document your expense methodologies, and then they're going to need to be disclosed somehow in the financial statements. Now, I'm not saying that you need to say, ooh, we allocate these 3 employees this way and these 4 employees this way. You have to come up with some general terms in terms of what your allocation methodologies are, but there's going to be an increased requirement of disclosure of allocation of costs and how those costs get allocated. So I gave you a couple little examples here. You have your management and general expenses. So if you think about it, when you think about your expenses, you have your program costs, you have your program administration, which are part of program, you have your management and general costs, and then you have your fundraising costs. So management and general costs are those costs that support the operations that cannot be directly assignable to another category. So we can't directly assign them to program or program administration, or they're not directly assignable to fundraising. So these are costs that you just, they're there to run the organization, but not directly assignable. So the definition that's given is supporting activities that are not directly identifiable with one or more program, fundraising, or membership development activities. So if it falls into that category, it's management in general. So some examples of that could be things like human resource, who really deals with all of the staff within the organization, or payroll processing, again, which is the recording of the payroll for everyone. It could be your fiscal department that's really dealing with the accounting for all of the various programs within the organization. So those would go under management in general, and those would get treated as a management in general expense. And then you'd have your expenses that are your programmatic expenses or your fundraising expenses. So these are the direct conduct or direct supervision of programs. So your direct conduct would be your program expenses or your direct fundraising expenses. And then your direct supervision would be your program administration type expenses. So these require allocations. So these are costs that are not necessarily, you could directly assign them. So if you happen to be doing time studies and tracking employees through time studies, you can directly assign them. Or if you're purchasing expenses for a particular program, you can directly assign them, or you can allocate them. But these are not expenses that are, these are expenses that you can discern and separate which program or which activity they belong to. So an example of a direct cost would be like a direct teacher or a therapist, or a supervisory role would be like a program director who oversees how the program is run. You could also have things like your CEO or your CFO could have certain programmatic activities that they're involved in. So part of their salary could get allocated over to program activities if they are functioning in a program or fundraising role. You could allocate them. You just have to have the substantiation support to be able to do that. We hear all the time, we have clients who are struggling sometimes with like their accounting department. I mentioned before that accounting is typically management in general. But if the accounting department is spending part of their time, working on a cost report for a particular program or working on a particular grant, you could argue that that type of cost would be a program administrative cost. Questions on any of this stuff? I need this to be interactive, guys. You have to ask questions. If you don't, I'm actually going to call on you guys. I think I have a thing here where I can actually point at people. So I'm actually going to be calling on people if you don't ask questions. So I think it's in your best interest to ask questions as we go. So this is an example of your statement of activities. So you can see that we have 3 columns. We have our without donor restriction column, we have our with donor restriction column, and we have our total. It's really, this is just a change in nomenclature. In the past, we still had this with our temporarily restricted and permanently restricted columns. We're just now calling it with and without donor restriction. So it's really the same sort of statement, except that, again, the names have changed to protect the innocent. So for those of you who have never done a statement of functional expenses before, this is what a statement of functional expenses looks like. So you have on it, you have your program services, and then you have your supporting services, and you come up with your total. So a statement of functional expenses represents all of the expenses of the organization. So all of the expenses get listed, and they're listed in both natural classification, salaries, fringe benefits, consultants, as well as your program classification, which is program management, general, and fundraising. So it's kind of a grid that shows both of them, because on your statement of activities, you're really just showing your totals for program management, general, and fundraising, and on your statement of functional expenses where all the detail goes. This statement is supposed to reflect all expenses of the organization. So if you have direct fundraising expenses, and those direct fundraising expenses for purposes of your statement of activities are offset against the income, you would still have to reflect them on the statement of functional expenses, then show them as a back out to come to your total expenses. The only expenses that don't get reflected on here are your investment expenses. Question?
Where I have employees who sometimes they're doing fundraising, sometimes they're doing education, do I have to then break down the allocation? In other words, like 35, 25, 10?
Yeah, I mean, what they should be doing is they should be filling out some sort of either time study or time reporting or something that allows you to move the cost to where that cost belongs based upon the level of effort that they're providing. She was a plant, by the way. I gave her that question to ask. Anybody else? So moving along. Within the accounting pronouncement, there were some changes to some of the definitions. So I provided everybody with a master glossary of some of those definitions. I'm not going to go through all of the definitions here. I'm going to leave you guys to read some of the definitions. But again, just understand that there were some changes to some of the definitions that existed within the pronouncement, and we listed those, some of those changed definitions. Any questions on the new financial accounting standard before we get to revenue recognition? I know you guys are all excited to get the revenue recognition. So the good part about revenue recognition is you have one more year. It doesn't go into effect for 2018 and fiscal 2019. It goes into effect for 2019 and fiscal 2020. Okay, so you have a whole year to kind of take this in. The rest of it, you have to kind of think about it now. So really, the standard is applied on a retrospective basis. So the reason we're kind of bringing it up now and we want to make sure that we're kind of focused on it today is because it is done on a retrospective basis. There's no exceptions. So if you want to provide comparative financial statements, your comparative financial statements, you have to then reflect the adoption of this pronouncement in your 2018 numbers if you're going to be preparing comparative financial statements. So that's why we want to make sure you're thinking about it now, because I know a lot of organizations like to produce comparative financial statements. So the thing to keep in mind is that this pronouncement is for exchange transactions. Anybody want to give me a definition of an exchange transaction? Pick you. I'm just kidding, Jeff, you don't have to give me. Anyway, an exchange transaction is a transaction where there is mutual benefit, or it's kind of think of it as a reciprocal transaction. So I'm giving something and I'm receiving something in exchange for what I'm giving. So the new accounting pronouncement only deals with exchange transactions. So if there's a charitable contribution is considered non-reciprocal, right? I give you money. You can argue you give me goodwill and I feel good about it, but still, I give you money. It's a one-sided transaction. So because it's non-reciprocal, the revenue recognition pronouncement does not come into play with respect to charitable contributions. So that's important. I want to make sure everybody understands that when we're dealing with this revenue recognition pronouncement, we're only dealing with exchange transactions. I was just given notice that I have a very short period of time, so I'm going to talk faster than I've been. Moving on. So the revenue recognition principles address all contracts with customers, except lease contracts aren't in play, insurance contracts, and that's not money coming from third-party insurance companies. Those are truly insurance contracts. It deals with financial instruments such as investment income and the like, guarantees and non-monetary exchanges. And as I said before, certain things are specifically excluded, contributions are specifically excluded, as are collaborative arrangements. So if I have a shared cost arrangement, that's excluded. Areas where this is going to impact nonprofits, if you have memberships, this is going to impact you. If you have subscriptions, products and service sales, royalty agreements, sponsorships, conferences and seminars, tuition and other fee-for-service arrangements, advertising, licensing, federal and state grants and contracts. These are all places where the new pronouncement could impact you. So when you think about the core principles, there are 5 core principles that you got to keep in mind when you go through this. You have to identify the contract with the customer. So what's the contract? Okay, the second thing you have to do is you have to identify what are the performance obligations. Remember, I said this was an exchange transaction. So since it's an exchange transaction, there are certain performance obligations that come into play. I have to do something as a nonprofit organization. So what is the performance obligation that I'm required to do? You have to determine what the transaction price is. And though that sounds kind of easy, it's not always the easiest thing in the world to determine what the transaction pricing is, especially if I've got a bundled transaction where there are multiple components to the transaction. You have to allocate the transaction price. Again, if I have a bundled transaction, I'll give you an example of that in a minute. And then you have to recognize revenue when a performance obligation is satisfied. That's why it's important to understand what the performance obligation is, because you recognize the revenue when you've met that performance obligation. All right? It sounds a lot more complex than it is. So as I said before, I mean, if you have a distinct good or service, it's a little bit easier, because if I've got a distinct good or service, the pricing is pretty clear. It's when I have bundled services, when I have more than one service that I'm providing, it gets a little more difficult, because I have to then determine how does the cost line up for each of the different components. So kind of give you an example, is a 10,000 membership to the Long Island Art Museum includes a table at their gala, 50 free passes to the museum, and 2 rounds of 4 at their golf outing. So if you think about it, I've got a $10,000 membership coming in. I've got to determine what is the price of my table, right, to the gala. I have to determine what 50 free passes to the museum are, and I have to determine the 2 rounds of golf. So those, if you think about it, those are my performance obligations. I have an obligation now under this to provide the table, the passes, and the rounds of golf. So anything in excess of those value of those performance obligations is considered a contribution, and you would recognize the revenue right up front, right? So you have to break it out between the exchange component and the non-exchange component. The exchange component gets recorded as performance obligation takes place. The non-exchange component gets recorded at the time the transaction takes place, because it's a contribution. And when do we record contributions? When they're pledged. Everybody getting all this? It's kind of clear, right? Good. So identifying the contract. So there's certain required contract criteria. I think that's kind of the easiest one of all of this, is kind of identifying the contract. Yes, do we have a contract in place? Do we not have a contract in place? But that's really the first step on this. So I'm going to kind of skip through that. Identifying the performance obligations. So the performance obligation is a promise in a contract with the customer to transfer to the customer either a good or service. So I'm either going to provide a service for you, or I'm going to provide you with a good, or a series of goods or services that are substantially the same. So I could say that I'm going to give you, for your membership, I'm going to give you a monthly newsletter. You're going to get the newsletter every single month. It's a series of services that are substantially the same. So some examples: Habitat for Humanity enters into a contract with a home buyer to build a home. So what's my performance obligation? My performance obligation is I'm going to build a home. Okay, Guide Dog Foundation's into a royalty agreement, which allows a commercial company to manufacture dog treats. Okay, so what's my performance obligation? My performance obligation is that I'm going to be receiving royalty payments in exchange for the use of my name, in essence. Village Child Development Center charges parents $1,000 a month to put their kids in daycare. So what's the performance obligation? It's the daycare component. And then Long Island Children's Museum, the naming rights. And the performance obligation would be we get a gift of $2 million and we're giving up signage and naming rights is what we're giving in exchange. Really quick, because I got to leave room for Ed. Determine the transaction price. So when you determine the transaction price, it could be a fixed amount, it could be a variable amount, it could be both. Is it something I said? Okay. We'll wait for her to get back. I don't want her to miss any of this. So when we think about, it could be, again, a fixed amount. So I could be giving 4 tickets to an event. That's a fixed amount. It could be a variable amount, a discount at the museum store or something, or it could be both. You know, I could have a cemetery plot as well as perpetual care on that cemetery plot. So there's a fixed component and a variable component. So you got to kind of decide how that valuation of the transaction prices hits to each one of those categories. So when you think about it, you have to look at several factors. So think about it in terms of, I'm just going to take you to the next slide. When you think about it, there are different ways that you can value. You can value using an adjusted market assessment, which is basically what you would, what people are paying for a similar item, cost plus margin. So what it costs you to provide the service with a built-in margin that you would normally build into what you do, or a residual value method. But the goal again there in the 4th step is to allocate that price to the various components of the performance obligations. And finally, the last piece is recognizing the revenue when you perform the obligation. So really quick, to give some time here for, so let's take an example here. So we have a not-for-profit organization has annual dues of $200. The only direct benefit members receive is a monthly newsletter with a fair value of $48. Okay? So what's the contract? Anybody, come on. What's the contract? So the contract is that we're going to provide a newsletter to our members in exchange for $48. Okay? The performance obligation is just what we talked about. The transaction price is $48, right? That's what the transaction price is. Even though they're paying $200, our transaction price is, remember, it's only the piece associated with the exchange transaction. So you would allocate the transaction price. Well, that's easy. It's all newsletter. So it's $48 to newsletter. And how would we recognize the revenue? We'd recognize $4 a month each month when we issue the newsletters, right? That's when we've met our performance obligation. Pretty easy, right? There we got it. So in our first year, the thing that's a little tricky is, or when we first get the membership dues, in the past, under the old rules, we would allocate that membership dues over 12 months, and we'd record it ratably over 12 months. Now, the only piece we're going to recognize over the 12 months is the $4 a month. The other $152, see, I can do that math really fast in my head, that other $152 is going to be recognized as revenue right up front as a contribution. So you'd recognize that, let's say this was in January. In January, you'd recognize the $152 under the new pronouncement. Everybody understand that? Everybody understand the differentiation there?
You would recognize the expense for printing the newsletter.
You would recognize the expense for printing the newsletter when you incur the expense for printing the newsletter. you're going to recognize the expense in essence, like I said, when you, so unless, again, think about it. If I print up the newsletter, most of the time the newsletter is printed at the time that I'm distributing, unless you're printing up 12 months worth of newsletters up front. Yeah. So I have another example. You guys can read the example. I just want to make sure that we have time. What? There's another question. Lola?
What about non-refundable deposits?
So if I have a non-refundable deposit, you would recognize the revenue when that non-refundable deposit is non-refundable. Okay. What? Well, that's, I mean, one of the key things here is if you think about an event a second. So if I have a fundraising event and I'm collecting money beforehand on the fundraising event, and the fundraising event isn't happening till sometime in the future. Remember, I mean, we're dealing with two different things here. That fundraising event, for the most part, is a contribution for most of the people, except for the exchange transaction piece. So let's remember, we got a $200 ticket price. $50 of it is the direct benefit to donor. $150 of it is the contribution component, right? That $50 under the regulations say you record the $50 when the obligation is met. When was the obligation met? When the event took place. Now, if you look at the other $150, which is a contribution, now you go back to contribution accounting. What does contribution accounting say? Contribution accounting says that you record a contribution when it's non-contingent. So if I don't have the event, do I get to keep the $150 contribution? I would say no. I would say that it's contingent upon the event taking place. So I wouldn't recognize the revenue on the $150 contribution until the event takes place anyway.
Yeah, I mean, I'm just asking more specifically around tuition deposits.
No, I understand that. And actually, if you look at the next example, the next example is actually just that. But yeah, I understand. When I was putting this presentation together, I gave myself an hour to do it. And then there were some new regulations that came down on the tax side, which I felt were extremely important and that you guys needed to hear about. So I asked Ed, who's part of our tax department, to come here and talk a little bit about some of the changes with the new tax regulations and how they're going to impact the nonprofit sector. So, Ed?
I don't know if it was so much asked as tricked me, but either way, here I am.